Welcome back to the Deep Dive. Today we're taking a close look at a company that's, well, practically part of the furniture in many Indian homes, Amrutanjan Health Care Ltd, or AHCL.
Yeah, absolutely. We've got their Q2 and half year results right here, ending September 30th, 2025, plus their investor presentation.
And this isn't just about the numbers, is it? We're looking at how this, legacy brand is really trying to adapt, protect its core business.
And also make some big plays in new growth areas. It's quite a dynamic picture.
Exactly. So our mission today is to get behind those headline figures. We want to understand how they're actually making money right now and what strategic bets they're laying down for the future.
And right off the bat, there's something tangible for investors. The board met November 10th, approved these numbers, and declared a first interim dividend, right one per share for FY26. So a bit of immediate good news there.
Okay, a sign of confidence. But here's what really struck me first, just glancing at the half-year numbers, the profit growth. It just blows the revenue growth out of the water.
That's the big story for H1, absolutely. The gap is significant. Profit growth way, way ahead of sales growth.
Right, so they're getting much more profitable on the sales they're making. Management calls this operating leverage, I believe.
Precisely. It means they're running leaner more efficiently. Let's break down those H1 numbers first.
Okay, let's do the scorecard for April to September 2025. Overall, revenue from operations, so net sales landed at INR 211.75 crores.
Which is, decent growth, up 9.35% compared to the first half of last year. Solid.
But then you look at the bottom line. That's where the fireworks are.
Monumental is the word I'd use. Profit before tax, PBT, up nearly 37%, and profit after tax soared 35.71%. Hit INR 22.27 crores.
So profit growing roughly 3.5 times faster than sales. That's significant leverage.
It really is. You're either slashing costs effectively or getting massive scale benefits. Or maybe a bit of both.
Okay, but drilling down into Q2 specifically, that quarter's net sales growth was a bit lower, wasn't it? Around 7.08%. Did they explain that slight slowdown?
They did, yeah. They flagged a new GST law kicking in late September. Apparently, it messed with their quarter-end billing cycle.
Ah, okay, so potentially just a timing issue, not necessarily weaker demand.
That seems to be the implication, more of an accounting or procedural hiccup right at the end of the quarter.
Got it. Let's circle back to that impressive profit jump then. If profit's up 35%, where did the savings come from? Let's look at expenses in H1.
Well, employee benefits were up about 12.6%, which you might expect with growth. But the real eye-opener is ad spend.
Advertisement and selling expenses. What happened there?
They actually cut it. Down 10.77% in the first half compared to last year. They spent about INR 21.1 crores versus nearly 24 crores before.
Hold on. They cut ad spend by over 10%. And still grew the top line by over 9% for the half.
Seems so.
Is that sustainable? I mean, are they potentially sacrificing future growth or brand health for short-term profit? Especially with those big expansion plans we'll talk about later.
That's the million-dollar question, isn't it? Right now, it looks like incredibly efficient conversion within their current customer base and distribution. But yeah, you have to wonder about the long-term impact. We'll need to keep an eye on that.
Okay. Well, let's see where the revenue is coming from. Section 2. Diving into the core segments, starting with the big one, pain management.
Yeah, this is Amrutanjan's heartland. Gross sales here were 148.3 crores in H1, and the category itself is performing really well.
Oh, well.
Overall, pain category grew 16% in H1. That's very healthy momentum.
And it looks like it's not just the classic balm driving this, right? The body category specifically seems to be on fire, up 21%. What's fueling that?
It's all about the newer formats. They're hitting a sweet spot. The Maha Strong variant, that saw 31% growth.
Wow.
And the back pain roll-on BPRO up 26%. Even the standard head roll-on surged 42%.
So people are really going for the roll-ons, less mess, targeted application.
Exactly. It seems consumers strongly prefer that format, and AHCL is really capitalizing on that trend. They've done well there.
Okay. Now, what about their other traditional area, congestion, the Relief brand? Much smaller segment.
Much smaller, yes. Only 6.8 crores in gross sales for H1. But there's a clear winner within that segment, too.
Which is?
The Relief Inhaler. That grew 28% in the half. Compare that to the Relief Rubs, which only grew about 6%.
So they're focusing their efforts there.
Seems like it. The commentary mentions targeted TV ads and on-ground activities for the congestion range, specifically calling out key markets like Tamil Nadu and Karnataka. They know where the growth is coming from.
Makes sense. Okay, let's move to Section 3. These are the categories they're really banking on for future growth. First up, women's hygiene, the Comfy brand.
Right. Now, Comfy, initially it looks a bit like a mixed bag. H1 gross sales were strong at 66.6 crores, but net sales growth, only 3.04%.
Hmm. Only 3% net growth for a key strategic brand sounds underwhelming, especially since Q2 net sales were basically flat. What's going on there?
Yeah, this needs explaining. It's down to an accounting standard adjustment, IND AS 115. It's a bit technical, but basically.
Let's break it down. What changed?
Okay, so before, they used to run these quantity purchase schemes, QPS. Basically, give away free product to distributors or retailers if they bought a certain amount.
Right, buy 10, get 1 free, that sort of thing.
Exactly. And under the old rules, that free product didn't really hit the reported revenue line directly. Now they've shifted from giving free product to giving a credit note, essentially a discount on future purchases.
Okay, and the accounting impact is?
The new standard treats that credit note as revenue they didn't collect, so it directly reduces the reported net sales figure.
Ah, so even if they ship the same amount of product, or even more, the way the discount is accounted for makes the net sales number look lower.
Precisely. The reported net sales are artificially suppressed compared to the actual volume moving through the channel. It masks the underlying demand.
That's a really important clarification. So if we ignore the accounting noise for a second and look at what consumers are actually buying, the internal metric, what do they show?
They show strong growth where it matters. The premium Comfy XL variant grew by a huge 44%, and the bigger value pack, the 18-unit one, shot up 47%.
Okay, that sounds more like a growth story.
Definitely. And crucially, that XL variant now makes up 37% of all Comfy sales, up significantly from 28% the year before. So consumers are trading up within the brand.
And the ambition for Comfy is huge, right? They're not just relying on current users.
Not at all. They're running multi-state TV campaigns. And the big goal, double the distribution reach, from about 500,000 outlets now
to 1 million outlets in the next 3 years. That is massive scaling.
It's a huge undertaking. Now let's look at the other potential growth engine, rehydration, the Electro Plus brand. This one had a tougher H1 overall.
Yeah, the numbers show H1 gross sales at 13.6 crores, but that was actually a decline, wasn't it? Down 4% for the half year.
Correct. A negative 4% for the full 6 months. But there's a positive twist in Q2.
Ooh. What happened in the second quarter?
Q2 revenue from operations for beverages actually showed really strong growth, up 26.55%.
Interesting. So a weak start to the year, maybe weather-related for a hydration drink, but a strong recovery in Q2.
That seems likely. And their marketing strategy here is completely different. Very modern, very digital.
How so?
Lots of focus on digital channels, Facebook, Instagram influencer campaigns, and very targeted physical activation, too.
Like the marathon sampling?
Exactly. Sampling and providing physiotherapy support at marathons. They also did a huge sampling push through quick commerce, reaching 300,000 consumers. Plus, they're pushing education, putting up posters, comparing their WHO spec ORS versus other drinks.
So really trying to drive trial and communicate the product difference directly, especially using digital and events.
Precisely. A very targeted modern playbook for that brand.
Okay, let's move into Section 4. This is about operational improvements and future strategy. What are the big product development moves they announced?
2 key things stand out, really showing their direction. First, they're launching a premium sanitary pad within the Comfy range, specifically targeting the night pad segment, aiming for more urban, maybe higher income consumers.
Premiumization within Comfy. Makes sense. And the second?
This one's interesting. They're reviving an old analgesic brand name, GIFFY, and launching a diclofenac topical range under it.
GIFFY. That's a name with history. So using that brand recognition to push into the body pain relief market more aggressively.
Exactly. Diclofenac is a key ingredient in that fast-growing body pain segment. Using the GIFFY name gives them instant credibility. It's a smart move to gain share there.
But strategy is one thing, execution is another. They talked about improvements there, too. What evidence did they provide?
They highlighted some internal metrics. Internal sales value up 37%, which is impressive. Manpower productivity up 16%.
And the inventory one, that seems significant.
Yeah. Closing stock decreased by 9 days. Getting inventory off the books 9 days faster is a huge win for working capital and overall efficiency. That's a concrete improvement.
And they're still hammering away at distribution expansion.
Absolutely. The goal is to add another 100,000 outlets in the chemist channel specifically.
Plus, they're investing heavily in getting people to actually try the products, right? those big sampling drives.
Yes, the trial generation piece is big. They mentioned reaching 50,000 consumers at the Ganpati Festival and a massive 130,000 at the Pantarpur Wari Festival. These are huge high-traffic events. They even did audio-video ads at bus stations.
It all ties together. And linking back to the ad spend cut earlier, maybe they're shifting spend from traditional ads to these direct trial activities in digital.
That could be part of it. They explicitly state they have the highest investment plan for this year on a digitally integrated communication strategy, so the money might be shifting, not just disappearing.
Okay, finally, the nuts and bolts organizational upgrades. What's happening on the operations and tech side?
Big move in manufacturing. The new sanitary napkin plant is on track to be commissioned by late Q4. That's crucial for Aid. Comfy gives them control over supply, potentially better margins, a strong enabler, as they put it.
And on the tech and people side?
They're pushing digital maturity hard, finalizing SAP integration for things like EPOD, electronic proof of delivery. That means real-time tracking and confirmation from their sales teams, streamlines everything. SAP payroll is also in progress.
And they mentioned a people-first philosophy.
Yeah, standard good stuff, succession planning, leadership programs, rewards, and recognition, building the internal capability alongside the external push.
So pulling it all together, it seems AHCL is doing two things really well right now. First, they're proving they can squeeze more profit out of their existing business, that operating leverage is real, driven by efficiency and maybe smarter spending.
Definitely. That 35% AT growth speaks volumes. But second, and maybe more importantly for the future, they are making serious investments.
Right. Reviving GOI, going premium with Comfy pads, building that new factory, and that massive goal of doubling Comfy's reach. These are not small bets.
No, there's significant strategic commitments. It's that classic balancing act. Optimize the present while investing heavily for the future. They've found internal efficiencies. Now they need the external bets to pay off.
Which leads us to the final thought for you, the listener. We see management pushing hard on digital transformation, on operational efficiency, like that new plant, and especially on that huge distribution expansion for Comfy, aiming for 1 million outlets.
Yeah, the ambition is clear.
So the question is, how quickly can all these investments in distribution, in marketing, in new products, translate into clear, consistent growth across the board on that top line, the revenue line? Especially given those accounting complexities we saw, like with Comfy in Q2. Will that efficiency we see now prove sustainable as they ramp up spending for growth? That's what we'll be watching.